There's a quiet assumption built into modern retirement planning that time automatically fixes volatility. That as long as you keep contributing, reinvesting, and ignoring the noise, the system absorbs shocks on your behalf. It feels rational, it feels disciplined, it even feels proven. But that confidence was built during a very specific era of expanding liquidity, predictable policy responses, and relatively stable global trade. What if that era wasn't normal but conditional? What if the real risk isn't a sudden crash, but a slow structural shift that changes how compounding behaves without announcing it? Before we talk about headlines or geopolitics, we need to examine the architecture you're trusting.
Your retirement account is not fragile. It is not a glass structure waiting to shatter at the first sign of geopolitical tension. For decades, long-term investing has absorbed wars, recessions, pandemics, and political cycles. Markets fell and then recovered. Contributions continued automatically. Compounding resumed. Institutions reinforced the same message. Stay invested, think long-term, volatility is normal. And historically, that message worked. If you consistently deployed capital into a diversified 401k, pension, or ISA, time did most of the heavy lifting. The system appeared self-correcting. That created a psychological baseline of safety. You internalized the idea that global instability might disrupt headlines, but not your long-term trajectory. But expanding war changes something subtle, not your app balance overnight, not your monthly contribution. It changes capital flows. Oil routes shift, shipping insurance premiums rise, defense budgets expand, sanctions fragment trade networks. Markets do not immediately collapse under these conditions. They reprice risk, slowly at first, then structurally. If your retirement account is primarily exposed to global equities and long-duration bonds, what happens when global stability becomes structurally uncertain rather than temporarily disrupted? We have been conditioned to believe markets always recover. The more precise question is whether recovery speed and recovery quality remain the same. As conflict expands, inflation pressures resurface. Energy prices rise, food costs follow, supply chains become less efficient. Central banks then face a constrained decision environment. In the United States, the Federal Reserve must balance price stability with financial stability. In the United Kingdom, the Bank of England faces a similar tension. If inflation accelerates again due to war-driven supply constraints, rate cuts become politically and economically dangerous. If rates remain elevated, bond prices struggle and equity valuations compress. Most retirement portfolios are built on a combination of these two pillars. The diversified portfolio assumption begins to strain under a high-rate, high-uncertainty environment. Nothing dramatic needs to occur. The pressure compounds quietly. Officials often remind us that pensions are long-term vehicles designed for turbulence. That statement is technically correct, but many 401ks are heavily equity-weighted. Many UK pensions carry exposure to long-dated government bonds. In 2022, leveraged liability-driven strategies within parts of the UK pension system experienced severe stress when gilt yields spiked. That was not theoretical volatility. That was a structural gap between assumptions and reality. Now layer geopolitical expansion, persistent inflation risk, record government debt levels, and higher baseline rates onto that framework. The system is resilient, but it is also highly interconnected. Logical tension builds without requiring sensationalism. So either war-driven volatility remains temporary, or it triggers a broader repricing of global assets. And if that repricing occurs, your retirement timeline does not collapse, it stretches. Compounding slows, optionality narrows, the conversion of labor into future freedom becomes less efficient. The hidden layer beneath this conversation is not fear, it is systems thinking. Your retirement account sits inside a larger macro structure shaped by debt issuance, monetary policy, fiscal expansion, and geopolitical alignment. When one layer shifts, pressure transfers somewhere else. After 2008, quantitative easing lowered rates and expanded liquidity. Asset prices inflated faster than wages. You were conditioned to buy the dip. Passive index investing dominated capital deployment. Globalization suppressed input costs and stabilized inflation. Your retirement account benefited from falling discount rates and expanding valuation multiples. That era created the illusion that volatility is an inconvenience rather than a structural reset mechanism. War expansion reverses certain globalization dynamics. Supply chains localize, strategic industries reshore, defense spending increases, liquidity becomes more selective. The assumption that everything quickly recovers depends on policy flexibility. War reduces flexibility. When war risk rises, oil markets react first. Higher oil feeds into inflation expectations. Bond yields adjust. Long-duration bond funds fall as yields rise. Equities reprice according to a higher risk premium. Currencies fluctuate. In the United States, most 401ks track broad indices with significant exposure to large-cap growth companies. In the UK, pensions frequently blend equities with gilts. If inflation expectations remain elevated, long-term bonds suffer because their fixed payments lose relative purchasing power. That affects pension funding ratios. The psychological shift happens when you realize it's not just stock volatility, it's duration risk, inflation repricing, and sovereign debt supply all interacting at once. War expansion also requires fiscal expansion. Governments borrow to finance defense commitments. Increased bond issuance raises supply. Higher supply, absent matching demand, can keep yields elevated. Elevated yields pressure growth-oriented equities because future cash flows are discounted more aggressively. At the same time, inflation risk reduces the real return of fixed income. Your retirement portfolio depends on macro stability more than you may have assumed. It's not a criticism of diversification, it's a recognition that diversification operates within a system that itself must remain functional. Central banks normally cut rates during crises, but if inflation remains sticky due to supply disruptions, cutting rates risks currency weakness and renewed price instability. Policymakers face a trilemma: protect growth, protect the currency, protect price stability. They cannot fully optimize all three simultaneously. If they suppress volatility aggressively, inflation can re-accelerate. If they fight inflation decisively, asset prices may stagnate for longer. Either path alters the speed of compounding, and compounding speed is everything when you're converting decades of labor into future autonomy. There are multiple plausible paths forward. A contained conflict might lead to a temporary dip followed by normalization. A prolonged multi-region expansion could sustain elevated inflation and rates, producing lower real returns for years. A severe escalation could trigger recession, forcing rate cuts and a sharp drawdown before eventual reset. Policymakers historically prefer financial stability over asset euphoria. They will tolerate slower retirement growth before tolerating systemic currency instability. That reality should recalibrate expectations rather than induce panic. Here's the framework that matters. Retirement resilience equals margin multiplied by optionality. Margin is the gap between your lifestyle cost and your income. Optionality is the flexibility created by liquidity, diversified income streams, and low fixed obligations. Most conversations focus on asset allocation. Fewer focus on personal profit margin. If your lifestyle has expanded to consume most of your income, your financial system has low shock absorption capacity. If you maintain margin, you can continue deploying capital consistently during volatility. Control versus consumption becomes central. Looking wealthy through visible lifestyle inflation reduces long-term optionality. Being wealthy is the quiet accumulation of deployable capital and resilience. The uncomfortable realization is that your retirement account is not your only retirement system. Your earning power, savings rate, and behavioral stability are equally important. If markets enter a prolonged lower return regime, the advantage shifts towards those with high personal profit margins and low lifestyle creep. Compounding still works, but the slope may flatten. The question becomes whether your psychological baseline can tolerate slower progress without abandoning strategy. The structural warning is simple. War expansion doesn't necessarily erase retirement accounts. It changes the environment in which compounding operates. Higher structural debt, fragmented trade networks, and constrained monetary policy reduce flexibility. That does not demand panic, it demands clarity about leverage, both national and personal. If governments increase leverage to finance defense commitments and households simultaneously increase leverage to sustain consumption, fragility compounds. If you maintain margin and deploy capital consistently, volatility becomes a transfer mechanism rather than a threat. This is where Nick Finance comes in, not as a source of stock tips or reactionary predictions, but as a place to recalibrate identity. If you're between 25 and 45, educated, working hard, earning well, and still feeling financially behind, it's not because you lack effort. It's often because you were given shallow frameworks. You were told to hustle harder or buy the dip without understanding the system those strategies operate within. On this channel, we step back and analyze the architecture. We look at profit margins, leverage exposure, optionality, and long-term trajectory. We examine the gap between looking wealthy and being wealthy. We treat your financial life as an integrated system, not a collection of isolated accounts. If this conversation made you slightly uncomfortable, that's intentional but respectful. Discomfort signals that your model is updating. The goal is not fear, it is autonomy. Over time, the most valuable asset you can build is not a specific fund position, it's a disciplined psychological base.